Hey everyone, welcome back to the channel. If you're watching live right now, jump in the chat and let me know where you're joining from. I love seeing where everyone's tuning in. So here's what's happening today, and this is huge. Let me show you. The Federal Reserve might cut interest rates later today. You can see the countdown on the screen. So only 5 hours, 9 minutes left. So we're talking Wednesday, September 17th at 2 p.m. Eastern Time. Now, if you're new to investing or you've never really paid attention to this stuff before, you might be thinking, okay, so what? But trust me, this could shake up the entire market, and I mean everything, like your savings, your investments, even the price of your next car loan. Whether you're just starting out with investing, you've got some money in the market, or you're just curious about how this whole thing works, you are in the right place. Here's what we're going to cover today. So we're gonna cover why everyone's making such a big deal about this rate cut, what might happen next in the market, which types of investments could go up, and where the smart money is probably moving right now. I'm also going to share what I'm personally thinking about all this, what I'm watching, what's got me excited, and what's keeping me up at night. Alright, let's dive in. Okay, so let's start from the beginning, because not everyone here is a Wall Street expert, and honestly, that's totally fine. I'd rather explain things clearly than lose half of you with fancy finance talk. So, what is a Federal Reserve? Think of it as the main bank for the entire United States. It's not like your local bank or where you go to get cash. It's a bank that all other banks work with. One of their biggest jobs is to keep the economy running smoothly. They do this by controlling something called the federal funds rate. That's just a fancy name for the interest rate that banks charge each other when they lend money back and forth. Here's how it works in simple terms. Let me explain that to you. When prices are going up too fast, that's called inflation. The Fed usually raises interest rates. This makes borrowing money more expensive, so people and businesses spend less money. That cools things down. But when the economy starts slowing down too much, the Fed can cut interest rates. This makes borrowing cheaper, so people and businesses are more likely to spend and invest money. That keeps the things moving again. So when the Fed cut rates, here's what happens. What will happen when the Fed cut rates? Let me tell you. Your loans get cheaper, it's easier to borrow money, there's more money flowing around, people are willing to take more risks with their money. Let me give you a real example. So for example, say you've been thinking about buying a house, but mortgage rates are too high. If the Fed cuts rates, your mortgage might get cheaper, and suddenly buying that house looks a lot more doable, right? Or maybe you've got credit card debt. Lower rates could mean you are paying less interest rates each month. And that's for individual, but for businesses, it's the same thing. Cheaper loans mean they might expand or invest in new equipment. And when businesses do well, their stock prices usually go up too, which is awesome. Alright, let's make this interactive. I want to hear from you guys. In the chat, drop me a number from 1 to 5. How much do you think interest rates actually affect your daily life? Drop me the number. 1, 2, 3, 4, 5. 1 means not at all, and 5 means they affect absolutely everything. Just join the chat, let me know you're there, alright? So another question for you guys. If borrowing money suddenly got way cheaper tomorrow, what's the first thing you'd do? Let me just maybe let me type the question in the chat. Drop the number 125 and how much do you think interest rates? I'm typing it. Just give me a second. So 1 means not at all, and 5 means absolutely everything. I just pinned the message in the chat, so everyone can see that right now. And another question for you guys: if borrowing money suddenly got way cheaper tomorrow, what's the first thing you do? Would you buy a house, start that business you've been thinking about, maybe pay off your debt faster, or something else entirely? Drop your answers in the chat. I want to see what you're thinking, because this stuff affects all of us differently. I will also type that question, alright? So if borrowing money suddenly got way cheaper tomorrow, what's the first thing you do? Drop your thoughts in the chat. Alright, so why is everyone expecting the Fed to cut rates today? Why? Let me paint you the bigger picture. For the past couple of years, the Fed has been raising rates like crazy. They were trying to fight inflation. Remember when everything was getting super expensive? Gas, groceries, rent, you name it. At one point, prices were going up by more than 9% per year. That's nuts. I still remember. Not pretty sure if you remember it or not, but that's really crazy. The Fed's plan worked, sort of. Inflation has cooled down to around 3% nowadays. That's much better, but it's still higher than the Fed's target of 2%, right? But here's the problem. While they were fighting inflation, they might have slowed down the economy a bit too much. Here's what we are seeing. Companies are not hiring as much people as they used to, and factories are not producing as much stuff. People are not spending as much money, and more people are falling behind on their credit card payments. Those are big problems. So now the Fed is in a very tough spot. Inflation is mostly under control, but the economy is starting to look shaky. That's why most people think they are going to cut rates by 0.25% today. 0.25% today. That's what we call 25 basis points in finance speak. And here's why this is such a big deal. This would be the first time the Fed has cut rates since the COVID pandemic. Remember back in 2020 when everything shut down? That was the last time they lowered the rates. If the Fed cut rates today, it's basically the Fed saying, oh, okay, we're done fighting inflation for now, and we're going to focus on keeping the economy strong instead. That's a huge shift, right? That shift is really huge. It changes everything for people who invest money, people who want to borrow money, really everyone. Okay, so here's my honest take on all of this. And you guys can totally disagree with me in the chat. just join the chat and let me know what you're thinking. All right, I think the Fed is getting nervous. Maybe they're very nervous right now, and I don't think I don't just mean about inflation. I think they're worried about some cracks starting to show in the economy. Sure, cutting rates might calm down the markets and make investors feel better, but it could also be signal that things are not as good as they seem. Because if you look at history, the Fed often starts cutting rates right before things get really tough, not after they've already gotten better. Now, I might be wrong. I might be wrong about this. Maybe everything's fine and this is just a small adjustment, but I'm keeping my eyes wide open. Let me see what you guys are saying in the chat. Thanks for joining. 215. Yeah, I saw that. Yeah, I know the rate cut affects everybody, right? More or less. So for anyone who just joined us, or if some of this finance stuff is still confusing, let me break it down really simply. I think of the Federal Reserve like the steering wheel of the entire US economy. If they turn the wheel one way by raising rates, it slows things down. Turn it too much and the economy stalls out. And if they turn the wheel the other way by cutting rates, it speeds things up. Turn it too much and things might get out of control. Right now, they're about to turn the wheel towards speeding things up by cutting interest rates. And when they do that, it affects everything. The stock market, bond prices, your savings account, right? And your loans, everything. I mean, basically everything. So, if you ever wondered why the stock market jumps around whenever the Fed makes an announcement, this is exactly why. These decisions ripple through the entire financial system, and that's just the beginning. We've got a lot more to cover, so stick around. So now here's where things get really interesting. Let me talk about what happens after the Fed actually cut rates. What will happen? Now, just the immediate knee-jerk reactions you see in the first few minutes, but the real psychology behind it all, how different groups of people react, what the big money managers are thinking about it, and what the experts are actually saying right now. I'm also going to share my personal take on all this. What I'm watching closely, what keeps me up at night, and what I think might actually happen next. Alright, let me share what the professional investors and big financial institutions are actually saying right now. Because I don't want to just give you generic advice. I want you to hear what people who move billions of dollars are thinking. So here's the deal. Pretty much everyone expects the Fed to cut rates by 0.25% today. That would bring the federal funds rate down to somewhere between 4% and 4.25%. But here's where it gets interesting. Let me show you. So the Morgan Stanley, that's one of the biggest investment banks. They think this is just at the beginning. Their economists believe we will see at least 2 more cuts before the year is over. And regarding the JP Morgan is saying the same thing as the Morgan Stanley did. They're expecting this cut today, but they're watching the jobs data and inflation numbers super closely to see if more cuts make sense. Let me break down what the professionals are saying that's making them think the Fed needs to cut rates. So first, the job market is getting wobbly. I want to type it down, for you guys. Why? So first, the job market is getting wobbly. And companies are not hiring as many people, and more folks are filing for unemployment benefits. Unemployment. That's not necessarily a disaster, but it's a trend that has a Fed's attention. And second, while inflation has come down from those crazy high levels we saw, it's still not where the Fed wants to be. And some parts of the inflation, especially services and wages, are being stubborn. The third, and this is a big one, the housing is a mess. Mortgage rates are so high that regular families cannot afford to buy homes, and home builders as you can see, the Home Builders Association is basically begging for rate cuts because nobody is buying houses right now. Now, different parts of the market react differently to rate cuts, and the experts have some interesting takes on this. For each companies and growth stocks, the thinking is pretty simple. When rates go down, future profits become more valuable. So companies that are expected to grow a lot in the future, like many tech companies, tend to do well where rates fall. But here's where it gets tricky. If the Fed only cut rates a few times, then cyclical sectors, that stuff like technology and industrial companies, usually do better. But if the Fed has to cut rates a lot because the economy is really struggling, then defensive sectors like healthcare and utilities start looking more attractive. Banks are in a weird sport. Some analysts think they will benefit because something called the yield curve, basically. Let me just type it down. The yield curve. So basically, if long-term rates stay high while short-term rates fall, banks can make more money. But if rates fall too much, bank profits could actually shrink. The housing and real estate people are probably the most excited about potential rate cuts. Lower rates should mean lower mortgage rates, which should mean more people can afford to buy homes. And then there's gold. Let's talk about the gold. Some big firms like Morgan Stanley are telling people to buy more gold because they think real interest rates are going to fall. Real interest rates are just a regular interest rates minus inflation. Let me type it down because I think that's useful for beginners. Real interest rates. That means regular interest rates minus inflation. All right. Now, of course, we need to pay attention to what could go wrong. The experts are also worried about some things. The biggest worry that inflation could come roaring back. Just because it's cooled down doesn't mean it's gone forever. If energy prices spike or supply chains get messed up again, inflation could surprise everyone. There's also the possibility that the economy is actually stronger than it looks. If that's the case, the Fed might not cut rates as much as people expect, and that could disappoint the markets. And here's something that doesn't get talked about enough. There's some concern about whether the Fed can make decisions without political pressure. Investors are watching this closely. So here's the thing, the markets don't wait for official announcement. Smart money is already moving based on what they think will happen. Bond investors are already buying longer-term bonds because they expect the yields to fall. When bond yields fall, bond prices go up, so they are positioning themselves to profit. The yield curve is doing something called steepening. Okay, let me type. Steepening. That's when the difference between short-term and long-term rates gets bigger. This usually helps banks and financial companies. Housing stocks have already started moving up because investors think lower rates will help the housing market. But here's the catch. Stock market have already rallied quite a bit just based on the expectations of a rate cut. Some strategists are warning that if the economy data doesn't support more cuts after this one, we could see some of those gains disappear pretty quickly. Now let me share a story that really shaped how I think about all this. A few years back, I had a friend who bought a house right after the Fed cut rates. For the first few months, he was thrilled. His mortgage rate was lower, his monthly payments were manageable, and he felt like he'd timed it perfectly. But then inflation stayed high longer than expected. His grocery bills went up, his energy costs shot up, and suddenly that affordable mortgage payment felt a lot less affordable. It taught me that the rate cuts can feel great at first, but the long-term effect depends on what happens with inflation and jobs. So here's what I'm personally watching really closely. First, I am going to hand on every word that Fed Chair Jerome Powell says today. So what did he say? Fed Chair Jerome Powell. His words. Is he going to sound dovish? That means hint at more cuts to come. Or is he going to be cautious and suggest that this might be a one-time thing? That tone is going to shape how markets react for weeks. And second, I'm watching the next few inflation reports like a hawk, especially core inflation. That's inflation without the volatile stuff like food and energy. If that starts creeping up again, the Fed might have to change course quickly. So, inflation reports. And third, I am tracking mortgage rates in real time. We need to pay attention to mortgage rates as well. Because here's the thing, even if the Fed cuts rates, mortgage lenders don't have to pass those savings on to you immediately. There's often a lag that matters a lot for housing and consumer confidence. And the last one, the fourth, I'm keeping an eye on international markets, especially emerging markets. International markets. When the US dollar weakens, which often happens when the Fed cuts rates, it can create opportunities in other countries. So now I know I've been throwing around some technical terms. Sounds very boring, right? So let me break down the important ones for anyone who's new to this stuff. So we talked about the basis points. So what is a basis point? Basis points. This is just a fancy way to say hundredths of a percent. So 25 basis points equals 0.25%. So let me type it down. Points that equals 0.25%. It sounds more complicated than it is. Just a fancy way to say stuff. And we talk about the yield curve. Yeah, here. Yield curve. So think of this as a graph showing interest rates for different time periods. Short-term rates on one side, long-term rates on the other. When the curve is steep, long-term rates are much higher than short-term rates. So when it is steep, okay. Long-term rates is, I don't want to type it all, higher than short-term. Okay, so when it is flat, what does it mean when it is flat? When it is flat, they are close together, closer. And we'll also talk about the duration. This is how sensitive a bond is to interest rate changes. Longer-term bonds are more sensitive, so when rates fall, long-term bonds go up in price more than short-term bonds. And we talked about the core inflation versus headline inflation. Core versus headline inflation. Headline inflation includes everything. So the headline inflation includes like food, gas, rent, like everything. Core inflation takes out food and energy because those prices jump around a lot. Economists like to look at core inflation to see the underlying trend. And we also talked about the steepening yield curve. Remember how I said banks borrow short-term and lend long-term? Well, when long-term rates are much higher than short-term rates, banks can potentially make more money. But if short-term rates fall too fast, that advantage can disappear. If any of this is still confusing, just type your question in the chat and I'll explain it again. Alright, so I know some of you are probably thinking about specific scenarios, so let me address the most common question I get. So will this rate cut make housing affordable again? Now we're talking about the housing. Here's my honest answer. It might help a bit. Might help a little bit, but probably not enough by itself. Yes, mortgage rates should come down somewhat, but some prices are still really high, and construction costs haven't fallen much. So while a rate cut provides some relief, we'd probably need several more cuts, plus some other changes to make housing truly affordable for most people again. So you might have the other question. Many people ask me this question in my WhatsApp group. I just saw it in real time when I'm doing the live streaming. So tech stocks are going to moon after this rate cut? Great question. Tech stocks often do well when rates fall because investors are willing to pay more for future growth. But, and this is important, it depends on whether investors still believe in that growth. If people start worrying about a recession, or if company profits disappoint, tech stocks can get hit hard even with lower rates. I'm cautiously optimistic about tech, but I'm not betting the farm on it. Alright, we talk about the tech. I just got another question from my group chat. What if inflation comes back and ruins everything? Thank you so much for the question. So this is honestly one of my biggest concerns. Will inflation comes back, and what if it comes back? Will it ruin everything? Inflation has cooled down, but it's not dead. No. If we get supply chain problems again, or if energy prices spike, or if wages start rising really fast, inflation could surprise everyone. If that happens, the Fed might have to reverse course and start raising rates again, which could really hurt the market. Just saw another question. I am not in the US. How does this affect me? Thank you so much for the question. When the Fed cuts rates, the US dollar often weakens. Depending on where you live, I'm not pretty sure where you're living right now, and it really depends on where you live. That could make imported goods more expensive or cheaper. It could also mean more investment money flows into emerging markets. But every country is different, so it really depends on your local economy and currency. Now, guys, let me be completely transparent about what I think is going to happen. Based on everything I'm seeing, I believe this rate cut is more of a signal than a solution. This is important. I'm gonna type it down. More of a signal than a solution. That's my opinion. The Fed is basically saying we are moving from fighting inflation to supporting the economy. But I don't think one rate cut is going to fix all the underlying issues. I expect we will probably see 2 more rate cuts this year, but only if inflation stays under control and the job market doesn't suddenly get strong again. And if jobs stay strong or inflation gets sticky, the Fed might pause. I think sectors like tech, home builders, and industrial companies have more upside potential in the near term. But I'm being really careful with banks. They could benefit if the yield curve steepens the right way, but they could also get hurt if their profit margins shrink. And I'm gonna tell you, here's my scariest scenario that keeps me up at night. What if inflation, especially in food or energy, spikes again? Or what if we get supply chain problems like chips shortages or shipping delays? That's so scary. Even just to think about it, I think it's so scary. Right? That could force the Fed to get tough on inflation again, and the markets would not like that at all. And for those of you investing in international markets or dealing with multiple currencies, keep an eye on currency risks. A weaker dollar can help some investments, but can also import inflation. Alright guys, let's do another poll. I want to see what you guys are thinking. So in the chat, let me know, tell me which sector do you think will benefit most in the next 3 months after this rate cut? What's your opinion? Let me type my question, all right? So, which sector, that's my question to you guys. Which sector will benefit most in the next 3 months after oh sorry, that's my typo. I mean, in the next 3 months after this rate cut. So I will give you the option. I'll give you 3 options. So A, the tech and growth stocks, and B, housing and real estate, and C, banks and financial companies, and D, defensive stuff like healthcare and utilities. Oh, I cannot type that. Alright. See, and I will send the D option D in a separate message, all right, in the chat. Just check it. So please type your choice and tell me why you picked it. I want to hear your reasoning. And if you are watching from outside the United States, definitely let me know where you're from and how you think U.S. rate cuts might affect your local markets. I am really curious about the international perspective here. Let me see those responses coming in. Now, I know some of you might be thinking about which sectors could move after this rate cut, and I'm really curious to hear your thoughts, whether you've been actively chatting or you're just watching and taking it all in. Now is a perfect time to jump into the conversation. Don't worry if this is your first comment or if you're not sure about the technical stuff. I want to hear from everyone, whether you're a complete beginner or you've been investing for years. Which sectors are you most excited about? Which ones are you worried about? Maybe you're thinking about a specific company in your portfolio, or maybe you're just trying to figure out where to put your money next. Whatever on your mind about how these rate cuts might shake things up, drop it in the chat and let's talk about it together. So, before we dive deeper, let me recap where we're at. Pretty much every expert agrees the Fed is going to cut rates by 0.25% today. The job market is getting softer. Inflation has cooled down, but still has some stubborn areas. Now let's get into the really practical stuff. Which sectors are likely to benefit the most? Which ones might get left behind? And why? I'm also going to share what I personally think is getting too much hype and what might be flying under the radar. I want to walk you through 6 major areas of the market. And before that, I want to show you the different sector of the stock by sector, different sectors. So what I'm gonna cover today will be tech and growth stocks, housing, real estate, and home builders, banks and financial companies, defensive sectors like healthcare and utilities, the precious metals and the commodities, other wild cards like consumer discretionary and emerging markets. So for each one, I will tell you what the experts are saying, what to keep an eye on, what could go wrong, and I will share some personal stories to make it all make sense. Now here we go, the first one, the tech and growth stocks. The tech sector is probably getting the most attention right now. Here's why. When the Fed cut rates and it hints at more cuts coming, that's called being dovish. Tech and growth stocks usually do really well. The thinking is pretty straightforward. The tech companies are often valued based on their future profits, not what they are making right now. When interest rates fall, those future profits become more valuable today. It's kind of like how a promise to pay $100 next year is worth more if interest rates are low versus high. And BlackRock, one of the world's biggest investment firms, is saying that as rates fall, long-term growth investments become more attractive as long as inflation doesn't come roaring back and long-term bond rates actually drop. So what I am watching for, there were a few key things that will determine whether tech stocks actually benefit from these rate cuts. The first one, the earnings report. We need to see if these tech companies are actually growing their profits, not just their stock prices. As it's very, very important, I will just type it down in the chat. So, earnings reports. Second, we also need to pay attention to the demand from different markets, their major markets. For example, from like NVIDIA's market from China and other international markets, right? The Tesla's Shanghai Gigafactory. A lot of big tech companies depend on global sales. So if the world economy is struggling, that could hurt them even with lower interest rates. And the third one, this is crucial. We need to see if long-term treasury yields actually fall. If they stay high, it limits how much tech stocks can benefit. And we also need to pay attention to the risk. Here's what could go wrong with the tech stocks. And if the Fed sounds cautious today, like we're only cutting once and then we will see. Growth stocks could get disappointed quickly. They are really sensitive to changes in expectations. So if inflation starts picking up again, especially in services or wages, that puts pressure on tech companies' costs. And many of these companies are already pretty expensive, so there's not a lot of room for error. No. I remember a few years back when Apple stock shot up right after the Fed rate cut. Everyone was talking about all the growth potential and future iPhone sales, but then a strong inflation report came out a month later, and people got nervous about whether the Fed would have to reverse course. The stock gave back a lot of those gains pretty quickly. It taught me a big lesson. It taught me that with tech stocks, it's not just about what happens today. It's about how confident people feel about what's coming next. That's really important. What people feel about what comes next and how confident they are. Guys, what do you guys think? Is tech overvalued right now, or is it still a good place to put money? Type tech yes or tech careful, or tell me your reasoning. Let me put my question in the chat. All right. Type the tech yes or tech careful. Let me put the emoji here. Drop your thoughts in the chat. So while you're considering it, let me share where my head's at on this. I am honestly torn on tech right now. On the one hand, you've got companies with incredible fundamentals, strong cash flows, dominant market positions, and they're still innovating at a crazy pace. When rates drop, these future earnings become more valuable, which is classic tech territory. But on the other hand, some of these valuations are just wild. We've got companies trading at multiples that assume everything goes perfectly for years. And here's what worries me. If the Fed cut rates but then has to pause because inflation doesn't cooperate, or if earnings disappoint even slightly, some of these high-flying names could come back to earth pretty fast. So I'm in the selective tech camp. Selective tech camp. I will just type in the chat. Woohoo! Love the sector, but I'm being really picky about which names and at what prices. Alright, now the second one, the next sector, we're gonna talk about the housing, the real estate, and home builders. I want to tell you what the experts are saying about this sector. This might be the sector that benefits most from rate cuts, at least in theory. When the Fed cut rates, mortgage rates usually follow, which should make homes more affordable and get people buying again. And bond investors are already positioning for this. They're expecting the Fed cut and buying housing-related stocks ahead of the announcement. But here's where it gets interesting. Give me a second. I want to show you the page. So PIMCO, let me just type it. PIMCO. I think everybody has heard about it. If not, don't worry, I will just explain. This is another big investment firm, Pacific Investment Management Company. It's saying the Fed should also stop selling of their mortgage-backed securities. Even with the rate cut, mortgage rates might not fall as much as people hope because of something called wide spreads, basically the actual market cap that lenders charge. The big question is whether mortgage lenders actually pass the Fed's rate cut on to consumers. Sometimes there's a delay, and sometimes banks just pocket the difference. I'm also watching home builders' earnings and outlooks, housing inventory levels, and construction costs. Materials and labor are still expensive, so even with lower rates, building new homes isn't cheap. Let's jump back to that page about the home builder because we're talking about that. And pay attention to housing starts and building permits. Those are early indicators of whether the housing market is actually recovering. And even if the Fed cut rates, home prices are still really high in most places. Yeah, I know that because there just are not enough homes for sale. So affordability might only improve a little bit. Also, if long-term interest rates don't fall much, mortgage rates might stay stubbornly high despite the Fed cut. Let me share a personal story with you guys. I have a cousin who's been trying to buy a house for over a year. When rates dropped a bit earlier this year, he got excited and started looking more seriously. But when he actually applied for a mortgage, he found out that his rate was still pretty high because the bank didn't pass through all the savings. He ended up waiting longer. It taught me that it's not just about what the Fed does, It's about what banks and mortgage lenders actually do with those rate cuts, with those rate changes. So, guys, if you're trying to buy a house, I'm not pretty sure if you're trying to buy a house. If you're trying to buy a house or you work in real estate, let me know in the chat. How do you think this rate cut might affect your personally? I'm curious to hear your real world perspective on this because the housing market is where rate cuts really hit home for people. While I wait for some of you to share your experiences, let me tell you what I'm thinking about the housing situation. This rate cut should theoretically help mortgage rates come down, but here's the reality. We might only see a modest drop, maybe a quarter point or so on mortgage rates. For someone looking at let's say $400,000 house, that could still save them a couple $100 a month, which is meaningful. But the bigger question is whether home prices have gotten so out of whack that even lower rates will not make much difference for affordability. That's a bigger question. I'm also wondering about the supply side. Are builders going to ramp up construction if borrowing costs drop for them too? And for those of you who are in the real estate sales, are you seeing buyers come back into the market just on the expectations of this card? And or are people still sitting on the sidelines? The housing market moves slower than stocks, so the real effects might take months to show up. Yeah. Now let's move on to the next sector. Let's switch the website. I wanna show you the sectors. Now we're moving to the next sector. We're gonna talk about the banks and financial companies. So for banks are in a complicated spot with the rate cuts. So on the one hand, something called the yield curve steepening could help them. That's when long-term rates stay high while short-term rates fall, and banks make money by borrowing short-term and lending long-term. But on the other hand, banks' net interest margins could shrink when short-term rates fall. That's basically their profit margin, the difference between what they pay depositors and what they charge borrowers. Insurance companies like Berkshire Hathaway might actually get hurt. Let me type the name. Berkshire Hathaway. Yeah, this big insurance company might get hurt because they keep a lot of cash and short-term bonds. When rates fall, their income from those investments goes down. So I'm watching whether banks actually increase their lending after the rate cut. Cheaper money is only helpful if people and businesses want to borrow it. Also, keeping an eye on the spread between what banks pay depositors versus what they charge borrowers. If that gap shrinks too much, bank profits suffer, and credit quality matters a lot. If the economy weakens and more people default on loans, that could offset any benefits from rate cuts. And if the Fed rate cuts too aggressively, it could actually hurt banks more than help them. And if lending standards get tighter because banks are worried about defaults, they might not lend more money even with lower rates. I actually worked at a bank early in my career, and I saw how rate cuts affected different departments differently. The mortgage team would get busy because more people wanted to refinance, but the commercial lending team sometimes struggled because businesses were nervous about borrowing during uncertain times. bankers are kind of caught in the middle. They can benefit from rate cuts, but they can also get squeezed depending on how everything plays out. Guys, anyone working in the bank, anyone working in banking or has strong opinions about financial stocks, let me know what you're seeing. I'm really curious about this sector because it's probably the most complicated play when it comes to rate cuts. While I'm waiting for some of you to chime in, let me walk through what I'm thinking about with the big financial names. You've got the major banks like JP Morgan Chase, JPM, Bank of America, BAC, Wells Fargo, WFC. Do you want me to type it down? Yes, I will do that for you guys. JP Morgan Chase and Bank of America and Wells Fargo and Citigroup. All right. I didn't type their tickers, but I think it's fine, right? If you want me to do that, just type in the chat. These guys should theoretically benefit if we get that yield curve steepening I mentioned earlier. When you've got the regional banks, which could be even more sensitive to rate changes. But here's where it gets tricky. If the Fed cuts rates and their net interest margins compress too much, it could actually hurt their profitability. I'm also watching the insurance companies like Berkshire Hathaway, BRKB, that's the ticker, BRK.B, which holds tons of cash and short-term bonds. Lower rates could really ding their investment income. And then there's the investment banks like Goldman Sachs. How can I forget this one? Oh, Goldman Sachs. And then, yes, Morgan Stanley, which might benefit from increased deal activity if lower rates boost the economy. The whole sector feels like it's at its crossroads where it could really win or really struggle depending on how this all plays out. Guys, if any of you work in this space in finance or have been trading these names, I'd love to hear what you're thinking. Alright? Type your thoughts in the chat and subscribe. Thank you so much. Like the stream. Now let's move on to the defensive sectors. These are called defensive sectors because they're supposed to be stable no matter what's happening in the economy. People still need medicine, right? People still need the electricity no matter what happens, and people will still need the groceries even during tough times. But here's the thing, when rates fall and investors get optimistic about growth, they often sell defensive stocks to buy riskier, more exciting investments. So these sectors might actually underperform in the short term. A very famous finance company, the BlackRock, and other firms suggest keeping some exposure to quality defensive companies as a hedge, just in case things don't go as planned. I am looking at earnings stability in these companies. Let me type it down. So you know what I'm talking about. For those who just joined the stream, you know what I'm talking about. We're talking about defensive sectors. All right. So when you look at this sector, when we talk about what will happen after the rate cuts, I'm looking at earnings stability in these companies. Are they actually as defensive as people think? Or are rising costs hurting their profits? Also, watching the dividend yields. Utility companies often pay decent dividends, But if bond yields fall a lot, those dividends might look less attractive by comparison. And regulatory pressure matter too, especially for utility dealing with energy costs and healthcare companies dealing with the drug pricing. So if the inflation picks up, so we're talking about the risks. If inflation picks up, it could really hurt those sectors because their input costs, energy, raw materials, labor could rise faster than they can raise prices. And if investors get really confident about growth stocks, defensive sectors could get left behind completely. My aunt has worked in healthcare insurance for years, and she always tells me that people pay for their medicine no matter what's happening with the economy. That gives healthcare company a certain stability. But she's also seeing how rising costs, both for medical treatments and general business expenses, can squeeze these companies' margins. So they feel safe, but they don't usually give you the big gains when everyone's feeling optimistic. Now we're moving to the next sector. We're talking about the fifth one, the precious metals and commodities. Yes, gold. You are right. We're gonna talk about the gold. Alright. Gold has been doing pretty well lately, partly because people expect rate cuts. Here's the logic. When interest rates fall, the opportunity cost of holding gold goes down. That sounds a little bit complicated, but don't worry, I will explain it just in a second. Let me just type it. When the interest rates fall and the opportunity cost of holding gold goes down, because gold doesn't pay interest, so when rates are high, other investments look more attractive. Also, rate cuts often weaken the US dollar, which makes gold more attractive since it's priced in dollars. Some analysts expect the dollar to weaken more, which could boost all kinds of commodities. Let me break down in simple terms. So think of it like this way. When you put money in a saving account or buy government bond, you earn interest on that money, right? But when you buy gold, it just sits there. It just sits there. It doesn't pay you anything while you own it. So when interest rates are high, like 5% or 6%, you might think, why would I buy gold? That pays me nothing. Why should I do that? When I can get 5% from a safe government bond, yeah, that's reasonable. But when the Fed cut rates, suddenly those safe investments are only paying you maybe 3% or 4%. Now, gold doesn't look so bad in comparison because the gap between what you could earn elsewhere and what gold pays you, which is zero, gets smaller. We call this the opportunity cost. Basically, what you're giving up by choosing gold instead of something else. I hope I make myself clear. If you have any questions, just put your question in the chat and I will explain it again. Alright. So we just talked about what's the meaning of the opportunity cost. So here's the second part that's important to understand. Gold prices around the world are set in US dollars. So if you're in, if I am in Europe and I want to buy gold, I have to use euros to buy dollars first, then use those dollars to buy gold. This is really important. Let me type it down. So gold prices all over the world. are set in USD. Oh no, US dollars. Alright. When the US dollar gets weaker, which often happens when the Fed cut rates, so it becomes cheaper for people in other countries to buy gold. More buyers usually means higher prices. Think of it like this. If gold crosses the $2,000 and the dollar is strong, someone in Europe might need to spend let's say 1,800 euros to buy that gold. But if the dollar weakens, maybe they only need 1,600 euros for the same gold. That makes it even more attractive to foreign buyers, and more demand pushes prices up. I'm watching for the inflation surprises. Inflation surprises are huge for commodities. If energy prices or materials cost spike, that's usually good for commodity investments. US dollar strength or weakness matters a lot. Most commodities are priced in dollars, so when the dollar weakens, they become cheaper for foreign buyers, and supply constraints, mining issues, transportation problems, geopolitical tensions can really move commodity prices. And let's talk about the risk about this sector. If inflation stays really low, or if real interest rates, regular rates minus inflation we talked about before, the real interest rates, yeah, you remember, we mentioned that earlier in this stream. Real interest rates equals to regular interest rates minus inflation. If real interest rates actually rise, gold could struggle, and if the dollar stays strong despite the rate cuts, that could hurt most commodity investments. So for me, I bought some gold a few years ago when I was worried about all the money printing and inflation. Yeah, I was so worried back that time. It didn't make me rich, but it did protect a part of my portfolio during the worst inflation periods. Back in COVID, near 2020 and 2019. For me, gold feels like insurance. It's not a flashy investment, but it's a safety net when everything else gets crazy. Now let's talk about some other sectors that could be an interesting place, what I like to call the wild cards. First up, consumer discretionary. These are companies that sell stuff people want but don't absolutely need. Think restaurants, travel companies, luxury goods, entertainment, retail stores. The basic idea here is pretty straightforward. When the Fed cut rates and people feel more optimistic about the economy, they are more likely to spend money on fun stuff rather than just the necessities. So if you're feeling good about your job security and borrowing money is cheaper, maybe you book that vacation you've been putting off, or you finally buy that new TV, right? Or you start eating out more often. And companies like Disney, Amazon's retail side, Starbucks, Nike, this kind of business could benefit if consumers start opening their wallets again. Then there's the emerging markets. Countries like Brazil, India, Mexico, South Korea, and others that are still developing their economies. Here's how this works. When the Fed cut rates in the US, it often makes the dollar weaker. When that happens, investors start looking for better returns in other countries. Think about it this way. If you're a big investment fund and you can only get 3% returns in the US after the Fed cut rates, you might look at a country like Brazil where you could potentially get 8% or 10% returns. some money flows out of the United States and into these emerging markets. These countries also benefit because when the United States rates are lower, it's easier for their governments and the companies to borrow money internationally. It's like the whole world's credit conditions get a little easier. But here's a catch, and this is very important. All right, guys, this is very important. Many of these countries have their own problems. Some are dealing with high inflation, others have unstable currencies, and some have political issues that make investors nervous. So while they might benefit from US rate cuts, it's definitely not guaranteed. All right, not guaranteed. Each country is different, and you really need to look at their individual situations before assuming they will all do well. And years ago, I booked a vacation assuming that airline prices would drop after the Fed cut rates, but then fuel prices spiked. Do you guys remember that time? And ticket prices didn't fall nearly as much as I expected. Well, that's a big lesson. It taught me that these discretionary sectors often look good in theory, but there are always other costs and factors that matter just as much. Alright guys, let me take a quick break to explain some terms I have been using for beginners. I hope this live stream is beginner friendly. Alright, so we talk about the net interest margin for banks. Let me type it down, the financial jargon. Net interest margin for banks. So imagine you borrow money cheaply from depositors and lend it out at a higher rate. The difference is your profit margin. When short-term rates drop, you might pay depositors less, but you also might earn less on new loans, so that profit margin can shrink. And we also talked about the steepening yield curve. Let me type it down. Steepening yield curve. So this is when long-term interest rates are much higher than short-term rates. More profit potential. If any of this is still confusing, just ask in the chat and I'll break it down further. Now let me be honest about what I think the market is getting wrong. Overhyped. I think people are getting too excited about consumer discretionary stocks. Yes, rate cuts might help consumer confidence, but food and gas prices are still eating into people's budgets. The math might not work out as well as people think. Also, a lot of companies are already priced assuming multiple rate cuts this year. If we only get 1 or 2 cuts, there could be some disappointment. And underrated, real estate and home builders actually look pretty good to me, but only if market rates really do fall significantly. It depends a lot on local regulations and also permitting processes and construction costs. I also think precious metals could surprise people if we get inflation surprises or if long-term yields drop more than expected. So my plans, I'm planning to overweight tech and home builders as short to medium-term plays. I'm keeping some defensive positions for safety, and I'm adding a small position in gold and mining stocks as a hedge against the things going wrong. Wow, we just covered a ton of different sectors and investment ideas. I know that was a lot to absorb, So let's take a breather here and make this more interactive. I want to hear what's on your mind right now. If you mentioned a specific company earlier, maybe Apple, or a bank stock, or a home builder you're watching, drop that company name in the chat again, and I will walk through how today's rate cut might affect it specifically. I love doing these real world examples because it makes all this theory actual practical. Also, if anything I just said caught you off guard, or if you think I'm completely wrong about something, please tell me. Please. Thank you. I'm not here to just talk to you. I want this to be a conversation. Maybe you work in one of these industries and you're seeing something I'm missing, or maybe you've got a different take on how these sectors might play out. And here's another option. If you want me to get into the crystal ball stuff, I can walk you through some specific scenarios about what might happen after this rate cut. We could talk through the worst case scenario where everything goes sideways, and the base case where things play out pretty much as expected, or the best case scenario where everything goes better than hoped. Each of these would mean very different things for your investors. So what's your biggest question right now? Let me know. What are you most curious about or most worried about when it comes to this rate cut? Yeah, guys, we've covered how different sectors might move, what the experts are saying, and what the main risks are. Now, I want to walk you through the 3 possible scenarios. What's the 3 different scenarios? What would actually happen after the Fed cuts rates today, depending on how things play out? I will break down what each scenario would mean for the markets, for different sectors, and for your money. I will also share which scenarios I think is most likely and what I'm personally watching for. Think of this as my roadmap for the next few months. So let me paint you 3 different pictures of how this could all play out. I will call them the base case, the best case, and the worst case. Base case, and the best case, and the worst case. For each one, I'll explain what happens and what it means for your investments. So the base case, what I think will probably happen, the Fed cuts rates by 0.25% today, and Jerome Powell sounds dovish but careful. Dovish means he hints that more cuts could be coming, but he's not making any big promises. Inflation keeps cooling down slowly. The job market gets a bit weaker, but not dramatically. Core inflation, that's inflation without the volatile food and energy prices, stays a little sticky but doesn't explode higher. The economic growth slows down, but we avoid a real recession. Maybe there's some mild recession risk, but the economy muddles through. And what happens to markets and sectors? For the base case, stocks rally modestly, especially growth stocks, tech, real estate, and small companies. Investors start moving money from safer investments into riskier ones, but there's still plenty of volatility. In the bull market, short-term yields fall, but long-term yields might not drop as much. This creates what we call a steepening yield curve, which is actually good for banks because they can borrow cheaply short-term and lend at higher long-term rates. And housing gets somewhat better. Mortgage rates edge down a little bit, and home builder stocks probably gain ground. For defensive sectors like healthcare and utilities might lag behind because everyone's chasing growth. But they still have value if things go wrong later. Let me explain that dovish tone thing I just mentioned. When the Fed is dovish, they are basically saying, we are cutting rates now, and we're watching everything closely. If we need to cut more, we will. That gives investors hope that the help is coming if the economy weakens. In this scenario, I'd put a bit more money into growth and tech stocks, and keep decent exposure to real estate and house in place. But I won't go crazy. I still keep some money in stable dividend stocks and defensive sectors as insurance. And I'd be watching inflation data really closely, especially wages and services inflation. If those start picking up, it could change the whole game. The Fed's press conference and something called the dot plot. That's where Fed officials forecast where they think interest rates, inflation, and jobs are heading. The next few inflation reports, especially housing costs and wage growth, whether mortgage lenders actually pass the Fed rate cut through to consumers, or if they keep the savings for themselves. And now let's talk about the scenario 2, the best case. Exciting? Yes, let's break it down. That's the optimistic view. So in the scenario 2, the Fed cuts by 0.25%, and Powell sounds really dovish. He signaled that 2 or more cuts are likely in the coming month. Inflation keeps falling, the job market slows just enough to bring down wage pressure, and economists start seeing signs that income growth and demand are recovering. This is where things get exciting. We see strong rallies in growth and tech stocks, plus small cap stocks and cyclical sectors like industrials and consumer discretionary. Real estate would do especially well, and REITs, that's a Real Estate Investment Trust, REITs, Real Estate Investment Trust, would get a strong bounce. Bond yields would fall on both the short end and the long end, which is great for long-term growth investments. Commodities might get stronger, especially ones tied to industrial demand. Precious metals like gold would benefit because something called real yields would drop. Let me explain the real yields. Real yield. So that's just the interest rate you earn minus inflation. If you're getting 3% on a bond but inflation is 2%, your really yield is just 1%. When really yields drop, investors often prefer assets like gold or growth stocks over bonds. The US dollar might weaken, which actually makes foreign investments and commodities more attractive to US investors. And if I really believe that this scenario was playing out, the second one I just mentioned, I'd be more aggressive, more money in tech, housing, and small cap stocks. Maybe some speculative growth plays. I might reduce my defensive positions because the risk to reward would look really good. I'd use any temporary pullbacks as buying opportunities. I'll just buy the dip. So now let's move on to the last scenario I mentioned. Oh no, the worst case, the scenario 3. That's the worst case. What keeps me up at night? Like a nightmare. So for the scenario 3, the Fed cuts by 0.25%, but Powell sounds cautious or mixed. Maybe he signaled this is just a one-time cut or warns that inflation is still a big risk. Meanwhile, inflation surprises to the upside. Maybe energy prices spike, or services inflation, or wages start accelerating again. The job market weakens more than expected, and long-term bond yields stay stubbornly high. This is where things get ugly. Stocks could get spooked, especially growth stocks and high-duration investments. Tech could drop significantly. Cyclical sectors would weaken because economic concerns were dominant. Banks and financial companies could get hurt if their net interest margins compress. What does that mean? Let me explain that. Net interest margin. I will also type it down. The net interest margin. All right. Net interest margin is basically how much profit banks make from difference between what they pay depositors and what they charge borrowers. Hope I made myself clear. If rates fall too much without enough lending demand, that profit margin shrinks. Real estate might see limited benefit because mortgage rates don't fall much since long-term yields stay high. The US dollar might actually strengthen as a safe haven, which would hurt commodities. And defensive sectors like healthcare, utilities, and consumer staples would perform better as people flee to safety. If I feared this scenario, I'd become much more defensive. I'd hold or increase my allocation to dividend-paying stocks and companies with stable cash flows. I'd keep more cash or cash-like assets ready in case there are buying opportunities during market dips. I'd use hedges or reduce exposure to high volatility companies or ones with a lot of debt. I'm not just making this up. These scenarios align with what professional analysts are warning about. Business Insider says the three sectors most likely to benefit from a Fed rate cut are small cap stocks, financial companies, and real estate, especially the REITs. And the Reuters report that bond investors are already positioning for long-term bonds, expecting the yield curve to steepen. That reflects the optimism about the rate cut. And also, Barron's made an interesting point. If there are only a few rate cuts, cyclical sectors like tech and industrial tend to outperform. But if there's a deeper cutting cycle with many cuts, defensive sectors also become attractive. What many analysts agree on this. What they agree on is that the tone after the cut is almost as important as the cut itself. Guys, let me be completely transparent about where I'm putting my money. I'm personally leaning into tech, not only just tech, real estate, and select financial companies, but in small amounts. I'm not betting the farm on any one scenario, any one of those three I just mentioned. I am keeping some defensive holdings, healthcare and consumer staples, plus a little gold and metals exposure as a hedge against the things going wrong. For speculative investments, I'm sizing positions smaller. If things look too overheated, I will take profits early rather than trying to ride every wave to the top. And I'm going to be watching the Fed communications very closely after the announcement at 2 p.m. today. Powell's words and tone will drive volatility for weeks, so I might time some of my entries and exits around that. So what to watch? What to watch? When the Fed makes their announcement, here's what I'll be watching in real time. The Fed statement text itself. I'm looking for changes in language, words like uncertain, risks, more cuts, or data dependent. The press conference and how Powell answers questions. What I just said, let me type it down. I said data dependent and risks and uncertainty and cuts. Cut maybe try multiple more cuts. Yeah. And his tone. The dot plot, if they release one, that shows how many cuts Fed officials expect and gives the market guidance about what's coming. Bond yields, especially comparing short-term rates like the 2-year Treasury to long-term rates like the 10-year, that the short end fall while the long end stays high. And the mortgage rates, I want to see if the lenders start passing through the fast cuts to consumers, and sector performance immediately after the announcement. I would just pay attention to that, the real performance. And are people selling defensive stocks to buy growth and the risk assets? Yeah. I know some of you might have specific questions, so let me address a few I often get, and I'm just checking my WhatsApp group. So here's the one: which scenario do you personally think will happen? Personally, I lean toward the base case, the first one. The Fed cuts 0.25%. Gives somewhat dovish signals, but doesn't commit to a lot of cuts ahead. That's just my personal perspective. Inflation is cooling, but still has some sticky parts, and the job market isn't collapsing, but is clearly weakening. I think the best case has real upside potential though, so I am positioning for both possibilities. And what if inflation comes back after the cut? If inflation rises again, especially in services or wages, the Fed might get really worried. Yes, they will be really worried, definitely. Even after cutting rates, markets could sell off because expectations for future cuts would shrink. Long-term rates might go up, which would hurt high growth stocks. That's exactly the risk in my worst case scenario. We talked about that. You see, worst case. We just talk about the base case, best case, worst case scenario. I am new to investing. What does priced in mean? That's a great question. Priced in. Priced in. Priced in. Priced in means that investors are already expecting something to happen and have adjusted stock and bond prices ahead of time. So if the Fed cuts by 0.25%, 0.25%, and everyone expected that, markets might not move much because it's already priced in. Because if the Fed surprises by being more dovish or cutting more than expected, that could lead to big moves. Now, which sectors seem too risky right now? Too risky right now. Which sector is too risky? Which sector seems too risky? I think some high growth tech stocks might be risky if long-term bond yields don't fall. Also, some speculative growth and momentum stocks might be overbought. Real estate looks attractive, but even there, if mortgage lenders don't lower rates for consumers, the benefit is limited. Financials are tricky. They could benefit from a steepening yield curve, but they could get hurt if their margins compress. Bottom line, guys, We've laid out 3 scenarios, and honestly, any of them could happen. The key is being prepared for multiple outcomes rather than betting everything on one. The Fed's decision today is just at the beginning, right? Just at the beginning. What really matters is what happens over the next few months with inflation, with jobs, and the Fed's ongoing communications. Now, I want to open this up to all of you guys. What question do you have? Let me know in the chat. What scenarios are you most worried about? If you mentioned a specific company earlier, bring it up again, and we will talk about how these scenarios might affect it. Let's dive into your questions now. So before we dive into question now, let's dive into some questions. This is a Q&A part, guys. Put your question in the chat. Otherwise, I will answer some questions from my WhatsApp group chat. All right. Before we dive into questions, let me share some fresh insights I have been seeing from the pros. This app helps show that we're staying current with what's actually happening. I saw this morning that PIMCO is urging the Fed to stop shrinking their holdings of mortgage-backed securities. They're thinking that even after the rate cut, mortgage rates might stay high because of wide spreads between what the Fed charges and what lenders charge consumers. So they want the Fed to do more than just cut rates. Bank of America just released their September Global Fund Manager Survey, and it's very interesting. Many fund managers are optimistic. They believe they will get a soft landing with Fed rates helping the economy. But here's the catch. Lots of them also think stock valuations are already too high. So even people expecting good things are nervous about prices. Business Insider is reporting that small cap stocks, financial companies, and real estates are expecting to be the biggest winners if the Fed cut rates, especially REITs. We have mentioned it a lot of times. Let me just And Reuters say bond investors are already positioning for longer-term bonds, increasing what they call duration, expecting the yield curve to steepen after the rate cut. Morgan Stanley is now forecasting 3 rate cuts this year. That's so optimistic in some of their scenarios. That's pretty aggressive. So you can see even the professionals are split between optimism about the cuts and worry about whether prices have gotten ahead of themselves. That's exactly where opportunity and risk meet. Alright, let's dive into your questions. So I want to hear what's specifically on your mind. Put your question in the chat. So what exactly does price in mean versus a surprise after the Fed decision? I have already answered that before, haven't I? Anyway, this is a really important concept. When we say something is priced in, it means that investors are already expecting it to happen and have adjusted stock and bond prices ahead of time. So if the Fed cuts rate by 0.25% and gives somewhat dovish signals, They might already be priced in because everyone expected it. The market reaction might be pretty muted, but a surprise would be if they cut 0.5%, or if Powell said something more aggressive like we are prepared to cut again soon. That could really move markets because it wasn't expected. Here's the tricky part. Sometimes the market sells off even on good news if it wasn't good enough. And often people trade based on what isn't said or how they sense it in the tone. Here's another question from my group member. I'm just starting to invest. Where should I put my money right now? If you're a beginner, I'd suggest a balanced approach rather than trying to make big bets on any one scenario. Alright? Maybe put some money in growth and tech stocks if you believe long-term yields will fall. Add some real estate or REITs to benefit from potential mortgage rate drops. Keep some defensive holdings like healthcare and consumer staples as a safety net. Please remember to avoid putting all of your money into speculative companies or ones with lots of debt because they are more vulnerable if things go wrong. And ETFs or broad index funds can also help you spread risk across many companies instead of betting on individual stocks. Now here's a big one. This one is awesome. I like it. I'm just scrolling my iPhone right now. So this one catch my eyes. How long does it actually take for rate cuts to affect the economy? This is important to understand. It doesn't happen immediately. No, rate cuts usually take months to ripple through the economy. Think about it. People need time to decide to borrow more money. Businesses need time to plan investments. Mortgage rates take time to adjust, and banks need time to change their lending standards. You might see stock market reactions pretty quickly, but the meaningful effects on things like hiring, housing activity, and business investment often show up over 3 to 6 months. That's why some people say you get a short-term bump than wait with rate cuts. Now the next one, what are the biggest risk factors we should watch after the cut? Several big ones to keep an eye on. Inflation surprises, especially in wages, energy, or supply chains. If inflation comes back, the Fed might have to reverse course. The Fed's tone. You also need to pay attention to the tone, alright? The Fed's tone. If Powell sounds hawkish or worried about inflation, it could spook markets even after a cut. After a cut, it could spook markets. And long-term interest rates staying high despite the Fed cut. That will limit benefits for things like mortgages and growth stocks. Lenders not passing through the rate cut to consumers. What if that happens, right? And the banks might just keep the extra profits instead of lowering your mortgage or credit card rates. Global risks like foreign economies weakening, currency moves, or trade tensions, any of this could reverse the gains from a rate cut pretty quickly. Next one is a 0.5% cut possible. What would that mean? Some people are hoping for 50 basis points instead of 25. That's really optimistic and that's really aggressive in my view. Most experts think 0.25% is more likely, but let's say they surprise with 0.5%. That would be much more aggressive and would likely signal the Fed things are weaker than markets realize. It could trigger big jumps in growth stocks, small caps, real estate, maybe commodities. But it might also raise concerns, like maybe the economy is in worse shape than we thought, or it could raise inflation fears if it seems like too much stimulus. More aggressive cuts mean more potential reward, but also more risk if the Fed overplays their hand. Now, how do rate cuts affect regular people's finances? Borrowers versus savers? This is where it is home for everyone. Borrowers usually benefit. Cheaper interest rates mean lower payments on mortgages, car loans, and credit cards, but only if lenders actually pass through the fast cut to you. Savers often get hurt because rates on savings accounts and CDs goes down. Your money earns less interest. But here's the key: inflation matters too. If your savings lose purchasing power because of inflation, even high interest rates might not help you. And if lower rates help the economy and your job security, that could be worth more than the interest you lose. There's always a trade-off. Is cutting rates safe if inflation isn't fully under control? Is cutting rates safe? Let me think. Is cutting rates safe if inflation isn't fully under control? This is one of the core tensions the Fed faces. If inflation really isn't under control, then cut rates would risk reigniting price increases. The Fed has to balance between stimulating growth and not letting inflation run away again. That's why analysts are watching core inflation, services inflation, and wage growth so closely. If those stay hot, the Fed might have to cut less or pause altogether. How does this affect people outside the US? When the Fed cut rates, the US dollar often weakens, depending on where that people live. That could mean imported goods become more expensive if your country uses dollars for trade, or cheaper if your local currency strengthens against the dollar. Investment money often flows toward emerging markets when US rates fall, which can help those economies. But every country has its own inflation policy and currency risks, so effects vary a lot. If you're investing in US markets from abroad, a weaker dollar could help your returns when you convert back to your local currency. Should I take profits now or hold through the volatility? This depends on your risk tolerance and time horizon. If you've made good gains, especially in speculative or high volatility stocks, taking some profit isn't a bad idea. You can always buy back in later if you want, but holding through volatility can also generate bigger returns if your thesis about the rate cuts and the growth plays out. One strategy I like is scanning in and out. Take some profits to lock in gains, leave some money invested for potential upside, and use those profits to either hedge your bets or move into safer positions. Now let me get some more interaction going here, guys. So what do you expect Powell's tone to be in the press conference? Dovish, hinting at more cuts? Or neutral, wait and see, hawkish, cautious about inflation? Drop your answer in the chat. Guys, I will type this question in the chat. What do you expect Powell's tone to be in the press conference. So I will give you three options, right? A, dovish, and B, neutral, and C, hawkish. Alright, here we go. I just send it in the chat. That's three options that you get. So dovish means hinting at more cuts, and neutral means wait and see. Hawkish, cautious about inflation. Drop your answer in the chat. Guys, maybe you can type one company you think will benefit from today's rate cut and tell me why. I will pick three and we will discuss whether they make sense. I see someone in the chat saying valuations are already too high. Yeah, I totally agree. That's one of my biggest concerns. Even if rate cuts happen, if companies are price assuming growth is guaranteed, there's not much room for any error. Any error. If earnings disappoint, those highly valued stocks could drop fast. Really fast. Someone in my group chat asked, why does everyone keep talking about bond yields? Do I need to care about that if I'm just buying stocks? Yeah, of course, yes, you absolutely should care. Bond yields influence how much return investors expect from riskier assets like stocks. If bond yields go up, growth stocks often need to offer higher expected returns to compete, which can hurt their prices. If yields fall, growth stocks often benefit because their future profits become more valuable relative to bonds. Think of bond yield movements like background wind affecting everything in the market. Alright everyone, thank you so much for staying with me through this deep dive. Your questions and comments are what make this live stream worth doing. Let me wrap up with the key takeaways with you guys. We're almost certainly going to see a 0.25% rate cut today with a dovish tone from Powell. But what really matters is what happens next. How inflation behaves over the upcoming months, how the Fed communications going forward, and how markets interpret those signals. I see opportunities in sectors like real estate, tech company with solid fundamentals and reasonable debt levels, and maybe some financial companies if the yield curve steepens the right way. But I also see risks. Inflation could surprise us. Bank might not pass rate cuts through to consumers, and valuations are stretched in many high-growth stocks. If you take just one thing away from today, let it be this. Don't put all your eggs in one basket, alright? Diversification. Diversify across sectors. Diversification is really important. Keep some defensive positions. And always pay attention to what the Fed says, not just what they do. Their words can be just as powerful as their actions. I'm thinking about doing a follow-up stream in about a month to see which of our scenarios, like base case, the best case, or worst case, actually played out. Those three scenarios we just talked about. Would you like me to do that, guys? If yes, just type it yes in the chat or leave a comment after this stream and let me know. And yes, let's make it happen. I will make it happen. If you haven't already, hit the subscribe and the notification bell so you don't miss that follow-up. And if you found this useful, share it with someone who's getting started with the investing. or someone who wonders what Fed rate cuts actually mean for real people. Thank you so much, guys. Thank you for spending your time with me today, almost 2 hours. Yes, thank you so much. I appreciate it. I'm genuinely excited to see how this all plays out. And I hope you are too. Stay sharp, watch the data, and remember, the best investors are the ones who prepare for multiple scenarios rather than betting everything on one outcome. So until next time, happy investing everyone. Take care. Bye-bye.